Will we see another quarter of earnings declines? Or will the third quarter of 2023 actually bring improvement? Well, our research director, Shiraz Mian, is here now with that answer and more. Shiraz, you wrote recently that so far the actual results have come in better than expected. So does that mean that we are going to see earnings growth this Q3?
Yes, Terry. The earnings are positive and not just growth, but it's broad based, and some of the fears that have persisted in the marketplace for a while now. This is another earnings season when those fears simply haven't materialized.
Okay, so that being the case, this would be the first quarter of positive earnings growth for S&P 500 companies since the third quarter of 2022. But does that actually call for a celebration? Should we pop the cork going forward? The estimates are coming down for Q4.
That's true, Terry. There's nothing like Terry Ruffalo destroying a party, but it is a cause for celebration, Terry. The positive earnings growth, and when we combine the companies that have reported and the few that are still to come, earnings for Q3 would be up about 2.8%, excluding energy, up almost 8%. So it is cause for celebration because the growth has arrived at least a quarter early. Initially, the expectation was that we will get into the positive year-over-year growth in the current period in Q4. So in that respect, it's positive. You do bring a good point with respect to the estimate revisions. Estimates for Q4 as well as for next year have started coming down relatively with more magnitude than what we had become used to seeing over the last few quarters. So in that respect, it's a bit concerning. But my sense is, Terry, that this is in line with the macro trends, with the economy moderating and this view kind of taking shape in the market, that we are heading towards a soft landing. And perhaps this negative revisions trend is no more concerning than estimates essentially getting in line with that economic reality.
Okay, so against that backdrop, let's look at the scorecard.
So we have 468 of the 500 S&P 500 companies have reported already. This is about 93.6% of the index's total. Earnings for these 468 are up 1.5%. Revenues are up 1.8%. 81.6% are beating EPS estimates, and 62% are beating revenue estimates. The EPS beats percentage rate is relatively in line with the historical trend that we've been seeing. Revenue beats, though, are relatively less frequent, and they are on the lower side relative to what we have seen in recent past. So that's the scorecard right now.
What's the story on margins? Have they bottomed? And if so, has the overall profit cycle bottomed?
I believe so. Margins have bottomed, and the overall profit cycle has bottomed as well. Part of that we see in the positive earnings growth that we were discussing earlier. But on the whole, for Q3 as a whole, when we look at it, margins are modestly up on a year-over-year basis. In fact, about 11 basis points positive margin growth in Q3 relative to the same period last year. So we have come a long way. Margins had bottomed a couple of quarters back and were steadily going back to the historical trend. We saw earlier in the year how the tech sector did some swift and massive layoffs and other adjustments to their business, and that really played a leading role in how the tech sector's earnings outlook and margin outlook has stabilized and improved. And as you know, tech has a far bigger weighting in the index than most other sectors, and that has been instrumental in improving the overall margin picture.
Speaking of sectors, as we talk here on the 16th of November, retail earnings are beginning to funnel in. What story are they telling, especially going into the holiday season?
Yes, so earnings are generally pretty good. As you know, Terry, we have a standalone retail sector, unlike the Standard & Poor's industry classifications, where retail is clubbed either in the discretionary or the consumer staple sector. So our retail, in addition to the Targets and the Walmarts and Macy's of the world, also has operators like Amazon and eBay and restaurant players. So as of today, we have about 78% of the retail sector companies in the S&P 500 have reported results already. Earnings for these companies are up 32.9%, and revenues are up 7.5%. 84% are beating EPS estimates, and a very strong 80% are beating revenue estimates. A big part of the very strong earnings growth that I mentioned is because of how strong and the easy comparisons Amazon had. But growth is pretty impressive, even excluding the contribution from Amazon. And more companies are beating EPS and revenue estimates than we have been seeing in the past. So on the whole, I believe the sector is in good shape. Perhaps expectations were a bit too low for the retail sector, that they have been able to easily overcome them. And there are some issues at the lower end of the income distribution, but on the whole, the economy, household finances, and buying power appears to be intact and resilient.
Have you seen any cracks this earnings season that are worth noting? I'm especially concerned about credit delinquencies being up and how that might affect that retail sector going forward.
Yes, so that is a concern, Terry. As I mentioned or touched on, that the lower end of the income distribution is more stressed. Thankfully, inflation is coming down, and thankfully, the labor market still remains at the multi-decade strong, and that is helping households maintain the buying power and the financial flexibility to maintain their spending trends. But there are uncertainties on the horizon. I mentioned earlier that the market is kind of latching on to the soft landing outlook for the economy, but the risk of recession cannot entirely be ruled out. And if we see cracks in the labor market, then these emerging signs of delinquencies that you rightly refer to, and we have had a number of companies reference those delinquencies and stress at the lower end of the income distribution, those will spread out, and then it becomes relatively self-fulfilling and feeding on itself by weighing on confidence and then spending trends. So there are worrying signs. We mentioned earlier the revisions trend, which remains negative and is in contrast to what we had been seeing in the last 2 quarters. Those are some of the weak spots in the broader picture, and definitely the delinquencies and weakness at the lower end of income distribution in the consumer economy is something that needs to be watched closely.
So what are the key takeaways then for this earnings season?
On the whole, Terry, earnings picture remains stable and resilient. The period of declines, some would even were referring to it as an earnings recession, is now coming to an end. And to the extent that in the macro picture, we are heading towards a period of moderation or softening growth, and nothing more sinister than that, then we are in a good place for that. You would recall we went through some massive estimate revisions last year, and my thesis all along was that those estimate revisions were in anticipation of the economic impact of what the Fed was trying to do. We had 2-3 quarters of stable to positive revisions trend, which was reversing some of those earlier negative cuts. And to the extent that the ongoing negative revisions that we referenced earlier in the context of Q4 remains just contained there and doesn't spread, then we have a pretty stable and reassuring earnings picture for the market.
So what do the numbers look like for Q4 with estimates coming down?
So we are essentially moving towards flatlining right now. We started out good 4-5% earnings growth. We are now down to 0.5% growth for Q4. My sense is that it's just been a little overdone, and actual numbers will be significantly better compared to these expectations, but they have come down far more than what we saw in the run-up to Q3 and in the run-up to Q2.
Okay. And with the Thanksgiving holiday coming up, I want to wish our audience a very happy Thanksgiving at this point. And we may do one more recap here for the year end in December. So be on the lookout for that. In the meantime, you can always take a look at Zacks.com's homepage to get Shiraz's updated earnings commentary. He changes it every Monday and every Thursday to reflect more accurately what's going on with earnings trends. And you can get a free book. Finding Number One Stocks is the title of the book. It's a 300-page hardcover where Zacks Executive Vice President Kevin Matras reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. Learn more about that at Zacks.com/promo. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.